Advanced Financial Modeling, Topic 1, Asset Risk and Return, Learning Objective number 2. We are going to estimate expected returns using the CAPM model. So let's talk about the CAPM model. It's one of the most important models in finance. And CAPM stands for the Capital Asset Pricing Model. And it is a model used to estimate the required or estimated return in the future of an asset given its risk. Every model starts with assumptions. The CAPM assumptions are the marginal investor, the average investor, holds a diversified market portfolio of assets. So if we're trying to find out the required return for holding, say, Capital One stock, you need to do that in a portfolio context, meaning that the investor already holds a large basket of stocks, say the S&P 500. And so we're going to evaluate the risk of Capital One relative to that large portfolio. Another assumption of the model is an individual risky asset like Capital One stock must provide at least a risk-free rate of return plus a risk premium. So this is kind of a no-brainer. If I'm going to buy an asset that has an uncertain return, by definition a risky return, the alternative is to buy a treasury that could give me a near certain rate of return. So I'm going to at least get compensation for equal to the risk-free rate of return, plus then a compensation for incremental risks. And that last thing, the risk premium, how much we're going to get in excess of the treasury rate, say the risk-free rate, is the incremental risk that's added from that individual stock to the very large portfolio, the market portfolio. And that risk measure in CAPM is called beta. So here's the model. CAPM says the expected or required rate of return for any asset I, we'll call that RI, the expected return of asset I, is equal to the risk-free rate, right? You got to at least get the risk-free rate, plus a compensation for risk. What is the compensation for risk? How much risk you have. We're going to calculate that, call that beta. And beta is going to be, what I'm going to show you later, is going to be a sensitivity of the stock market, or the stock I to the market M. And multiply times that times the market risk premium is the excess return you get for that unit of risk. So let's think about this in CAPM in really big picture. Return of any asset I is equal to the risk-free rate plus a compensation for risk. What is the compensation for risk? A measure of risk beta times the compensation per unit of measure of risk, market risk premium. Now that risk-free rate can be the 1-year treasury rate, but often is modeled as the 10-year treasury rate. So in theory, we are predicting a 1-year rate of return. So sometimes this model often uses the 1-year treasury rate as the RF. However, I'm going to follow the lead from Aswath Damodaran from NYU, who's kind of written the Bible on investing. And he makes a pretty good argument that if you're going to compare buying a stock to holding another investment, it's going to be a long-term investment. You're not going to buy the stock versus hold, say, T-bills. You're probably comparing that to another long-term investment. So Aswath Damodaran makes a good argument that the risk-free rate should be long-term treasury yields. All right, the market risk premium. The market risk premium is the compensation of the stock market over the risk-free rate. So say on average, the stock market returns 10, and on average, the treasuries were 5. So you can say, well, if the market risk premium was 5, or if on average the stock market return has been 12 and treasuries have been 5, you can say the average market risk premium has been 7. So the market risk premium is the extra return that the stock market returns over the risk-free rate of return. And we'll call that the return on the market. So we'll use the S&P 500 as the return of the market or the market proxy. Now, we ideally would like a forward-looking market risk premium, not just what it did over the past, but in the future. So you have to estimate the market risk premium. In practice, I've seen market risk premiums in the 3 to 7% range, which is kind of scary because that's a big difference, between 3 and 7%. But we'll talk about where to get some of those values. Now, how do I get the beta? Beta is the sensitivity of any individual stock, say Capital One stock, to the market. So again, the assumption of CAPM is the investor holds a diversified market portfolio, say the S&P 500. So when we evaluate the risk of Capital One, we do that relative to the market. So you calculate beta. Now, beta is relatively easy to calculate using historical data. You can just run a regression where you regress the excess returns of, say, Capital One Financial over the excess returns of the S&P 500. When I say excess returns, that would be the returns minus the risk-free rate. So I just need two data series. What are the returns of Capital One in excess of the risk-free rate of return? What are the returns of the market or S&P 500 minus the risk-free rate? Run a regression and get the slope of that regression, or something called the coefficient. So let's go ahead and do that. We're going to grab our data. I'm going to go back to our start file that we worked on in topic 1. And in topic 1, you remember I had asset prices for these assets. I had monthly returns for these assets, so Capital One, Tesla, La-Z-Boy, and so on. So here I want to calculate excess returns, the returns of the assets minus the risk-free rate for that month. So I'm going to start off with an equals or plus, doesn't matter here, and say the return of Capital One in that first month minus the treasury rate for that month. Now I'd like to copy this down and over. So here's what I'm going to do. I'm going to take that formula, and since the 10-year rate, the risk-free rate, is in column P, I'm going to put a $ in front of P. What that's going to do is when I copy this formula to the right, normally that P would turn to a Q. But by putting a $ in front of the P, it's going to anchor it. So when I copy this to here, notice this stays at P and doesn't turn to Q. So what I'm going to do is I'm going to copy this formula down. That's going to give me my monthly returns, excess returns. And then, whoops, one more. And then I'm going to drag this over to do it for all stocks. So now I have excess returns of Capital One, Tesla, La-Z-Boy, S&P 500, EMA, and EFA. So now to get the beta, what I need to do is run a regression of the returns of, say, Capital One versus the S&P 500, which is my market portfolio. So I'm going to come up here to the top of the spreadsheet. And I'm going to say, well, there's two ways to get a beta or a regression coefficient in Excel. I could do data analysis and run a regression and observe the slope or the coefficient. However, in Excel, if all you really want is that slope or coefficient, you can just say equals slope. And it says, when I say equals slope, that's a known Excel built-in function. And it says known y's and known x's. Y's are going to be the dependent variable. So I'm going to put in the excess returns of Capital One, Control-Shift down, comma. So I now have the y variable is the Capital One returns. I'll come back up here, and then my x variable is for CAPM model is always going to be the market, Control-Shift down. I'm going to hit F4 now. Notice what F4 is doing right now. F4, while I was holding that range, while I still selected that range, and I hit F4, it automatically put $ in front of both the row and column index. So what that allows me to do is when I copy this formula to the right to get the excess returns of Tesla, I still want to use the excess returns of the S&P 500. So I'm going to, whoops, looks like something's out of whack there. Whoops, looks like there's one less data point. Notice that these have to be the same size. This goes from 34 to 33. Let's just verify that this does start in 34. So I'm going to go back up to my formula here. And let's change this to 34. And then I have my CAPM beta. I can then copy this over. Notice when I do Tesla, it's still using the market portfolio. And you can see it's working because when I calculate the beta of the S&P 500, it is the slope of the S&P against the S&P 500, which is 1. And then here is a EMA and EFA. So I have my full sample beta. When I say full sample, it's using all 10 years of monthly returns. How do I interpret these betas? A beta of 1 means that it has the same risk as the S&P 500, and you can see the beta of the S&P 500 is 1. It has the same risk as the market. Capital One has 1.4. Anything above 1 means that its risk is higher than the market. And so you can see all of these assets have a beta greater than 1. Tesla is the highest beta of 1.84. I tend to see betas somewhere in the range of, say, 0.5 to about 2 to 3. 0.5 are usually stocks which are relatively defensive, say companies that make food. They're not too sensitive to the overall stock market. And the companies that have high betas are ones in which usually tend to sell luxury goods or things like heavy equipment that quickly is not bought when companies are going through a recession. All right, so there we have our betas. And now we're going to calculate the capital asset pricing model value. So we have our data so far. And we're going to go calculate our CAPM. But before I do that, I just want to show you one thing. I computed betas here also using the same formula, but I only used the last 3 years data, not the last 10 years data. So what this tells me is if I just look at the last 3 years, Capital One, its beta is much lower. This points to the fact that estimating beta is a risky thing to do. No pun intended. It changes all the time as companies get more and less sensitive to the market. So I'm just going to do that for FYI, for your information only purposes. I'm going to use the full sample beta for 10 years for this exercise. Probably a common practice might be used to use 2 to 5 years. All right, so Capital One return. What I meant to get a Capital One model return, I need the risk-free rate plus the beta times the market risk premium. I have a 10-year rate of 397 as the writing of this lecture. The 10-year treasury was 3.97% yield to maturity. I have a historical risk premium of 6.8%. So where did I get this? Notice that this is a formula that goes to this tab, Market Returns, 1928 to 2023. So if you click on this Market Returns, I have data from 1928 to 2023. Here's the return on the S&P 500, including dividends, so it's total return. And here's the 10-year treasury. So in 1928, the market was up 43%, and 10-year treasuries were at 0.84. So if I take the difference, the stock market outperformed treasuries by 42%. So that is the risk premium for that year. The average of almost 100 years of risk premiums. The average of this column here is what I'm using here. Over the last almost 100 years, the stock market has exceeded the 10-year treasury by about almost 7%. So we'll call that the historical market risk premium. That data set, by the way, is from Aswath Damodaran from NYU. You can Google him and get his data set anytime you want. So if I use that number, equals risk-free rate plus the beta, we'll use the full sample beta, times the historical market risk premium, hit enter. So based on the beta of Capital One, you should expect a 13.5% return in the next year, or on average in the future, annualized return of 13.5, and you can copy across. All right, a couple other things I want to show you here. In this spreadsheet, notice if I click on this cell, what is this, J3? If you look over here, you can see that this is J3, but I've also given this cell a name. Normally, when you click on a cell, you'll just see D7, or if I click over here, you'll see E9. But if you click on this cell, notice it has a name of RF. That's because you could take any cell in Excel and give it a name and refer to that name later. So for example, my name is Lou. I can put a number here, say 9. and that cell happens to be H3. I could then give that cell a name by just clicking H3, coming over here and just say LOU. Now this cell has a name of Lou. Anytime you want to use that number in Lou, I can just say equals Lou. And notice the 9 comes up. So I've already done that. I've named this cell RF. I've named this cell MRP. So notice when I clicked on them in the spreadsheet, I got RF and MRP, and they're automatically anchored. So I could have just written the formula equals RF plus the beta times MRP. So I could have written it that way. There we go. So there's the returns of the CAPM expected returns. So a couple things about CAPM. The advantages of CAPM is it's very theoretically appealing, meaning that how could you argue that the average investor isn't fully diversified into a market portfolio? Why would anyone be dumb enough to hold one stock? And why would anyone not think that every risky asset has to get at least the risk-free rate of return plus a compensation for risk? Another advantage of this is it's widely used. So if everyone else is using it and it's wrong, you probably won't lose your job. And it requires few inputs. I just need treasury rates, which are easily observed. RF, I need a beta, which can be calculated relatively easy using a few years of market and stock returns. And then I need a market risk premium, which is a little bit tough. The market risk premiums, again, I've seen estimates of 3 to 10% or 3 to 8% probably. I'm going to talk about market risk premiums a little bit more. In the spreadsheet, I also have a number called the implied risk premium. If you Google Aswath Damodaran, there's this Aswath Damodaran, and click and also Google implied market risk premium. What he has on a quarterly basis, he estimates what a forward-looking risk premium is. And how he does it, you can read his methodology. He basically looks at the current price of the S&P 500, the current estimates of growth of cash flows of the S&P 500, and kind of backs into what rate of return what discount rate or rate of return justifies the current level of the S&P 500 and the estimate of cash flows. So Damodaran estimates that looking forward, we shouldn't expect 6.8. We should expect 4.6. So this enters judgment into this calculation. So what am I going to use for market risk premium? I don't know. I could justify 6.8. I got 100 years of data, but Damodaran makes a point that the stock market has gone through quite a big boom, and maybe with the current cash flow estimates, we shouldn't expect a higher return in the future, or as high a return. I'm just going to use 5. Why is it? It's because it's between 6.8 and 4.6, and humans were born with 5 fingers, and for some reason, if you use a number of 5 or 10, people don't doubt you. So I'm going to use a number of 5. So I'm going to rechange. Here's my final MRP estimate is going to be risk-free rate plus beta times, and I'll just use this 5%. I'm just going to anchor it there, F4. So there is my best guess as the expected returns of Capital One, 10.97%, Tesla, 13%, Lazy Boy, 9%, EMA 795, EFA 833. All right, so these are my best guesses of the stock market, or I'm sorry, the asset returns. A couple other things I want to talk about when we talk about CAPM. That is, betas do change over time. So if you put in the 3-year sample betas versus the 10-year average, I'm probably more comfortable using the last 3 years because a lot of companies, their leverage changes over time and the business model changes over time. Another disadvantage, and so that's a disadvantage of CAPM, is the betas are changing and market risk premiums are changing and are uncertain. Another disadvantage of CAPM is there's other factors that have been shown to be drive stock returns. For example, historically, small cap stocks have outperformed big cap stocks or big caps. And high book value stocks tend to outperform low book to value low book to value. So for some reason, the size of a firm matters and the book to market ratios matter, and that's not in the CAPM model, but it's been shown consistently to have an effect on stock returns. All right, so that's going to lead to a model I'm going to give you in a little bit called the Fama-French model, which is basically CAPM, and it adds a couple more factors for these. One technical note. When I calculate the beta, I did calculate the regression coefficient when I regress the stock's excess returns over against the market's excess returns. However, in practice, we don't always have excess returns, and we just use stock returns and market returns and don't subtract the risk-free rate. And that's very common for daily and weekly returns when you're doing the regression. So you'll see that in practice, that you just regress the returns of the stock and not excess returns. All right, so this topic was estimating returns using the CAPM model. The next topic we're going to start our introduction of the course to VBA by writing a very, very simple VBA program and create it as a user-defined function and use that in Excel. So that's next.